And welcome back to another episode of the Credit Authority. I am so glad that you tuned in today because we love to bring you special guests. So today I am with my friend Peter Pescatore with Jet Direct Mortgage. How are you?
Doing well. How about yourself?
I'm doing okay. I love to do the best I can to support the people that I work with. So you guys have been awesome, right? So I'm a huge fan for years of Jet Direct and the service that you guys offer, right? We've been a great power team for the last few years. But I think every time I bring somebody on the show, it's so easy to talk about blaming the market and blaming the Fed and blaming change, right? And every time we turn around, it's always like we have these conversations like, hey, what's going on? Market sucks. Hey, what's going on? Rates are up. Hey, what's going on? So it's always the same old. So I'm thinking today, maybe just for the sake of I'll call it like a lesson.
Sure.
Let's talk about declines. Yep. Why does somebody get declined? Of course, your job is to approve everybody, but Big Brother, right, is there's levels here. Big Brother is still behind you saying, hey, Peter, they might seem really nice, but it's not going to work.
Yeah, absolutely. So, let's just even take a little step backwards. So when you mentioned Big Brother, you have Fannie Mae, Freddie Mac. They're the two agencies that really dictate most of the guidelines with conventional loans. You also have FHA, which basically is really the first-time home buyers, the low credit scores, and they're the ones that are dictating the guidelines for the secondary market. So no matter what bank you are, whether you're Chase Manhattan Bank, Jet Direct, Wells Fargo, Bank of America, you all are beholden to these guidelines. So regardless of what decisions we want to make, sometimes we don't have the ability to make those deals. Yeah. So there are gray areas and there's things that we can do to work around it, but the reality is if you have a 400 credit score and you don't pay your bills, we're not able to get you a mortgage. Now we can work on credit repair, we can work on different things to try to increase your score and over time fix those issues. But again, if you come in the door and you have a 400 credit score, you have a foreclosure, a bankruptcy, it's a possibility that we really just can't give you finance at that time based on those guidelines, based on those secondary market rules.
And if you think about it, we have I should say, these conversations with clients, which is more that while we're speaking with the client, they have bad credit. They're in this position where they're not paying their bills on time. They're strapped. They have collections, right? They have maybe 5 or 6 collections on their credit report. And I'll get a referral from your office. I'm taking a look and I'll say to the client, okay, so let's take a look at your credit. You are a low 500. I spoke to Pete. We need to get you over a 620. We're going to have conversation about paying off your collections. They want to buy a house on Long Island for $500,000, but they won't pay off the $2,000 worth of collections that are on their credit. It almost has to make sense.
Sure.
Is that really the borrower that you want to provide opportunity to?
Well, and it's not. And really, when we're taking a look at a credit board, and you know this from your time in credit repair, there's really 2 types of borrowers with bad credit. There's those that had a one-time event where something went wrong, a death in the family, an illness, sickness, maybe cancer, something horrible where there's a tragic event that caused that credit issue, and they're working toward repairing that. And then unfortunately, as you know, there's people that have habitual credit abuse. Every 2 to 3 years you look at the credit report and they just let everything go. They have collections, foreclosures, bankruptcies, and no matter what you do, in 2 or 3 years, unfortunately, unless they fix the way that they handle their finances, they're on the same trajectory.
Yeah. Because the last thing you want is a first payment default.
No, absolutely. Look, we're a bank. We're in the business of lending money and getting money paid back to us, So that's the gig.
Let's talk about that. You are a direct lender.
Yep.
Explain to everybody the difference between a direct lender and a broker.
The biggest difference is this. We make our own decisions. We have our own money. We actually lend the money. Where a broker is nothing more than a middle person who brings the borrowers to us to basically get the money. So at the end of the day, basically, it's really our bank, our decisions, our money. Where the broker, they have great relationships with their CPAs, financial planners, realtors to try to get borrowers, but ultimately they don't have that decision making. They bring it to us to make that decision.
Is that, and this might sound like a crazy question, but Jet Direct is a nice sized company.
Sure.
You have a lot of loan officers. You're located in almost every state.
Yep.
Is there a wholesale division?
We don't have it.
Does that make sense?
We do, and we had it years ago. Unfortunately, the reality is if you look at the statistics, broker business defaults at a much higher rate than retail business, and that's just
because they don't have the liability associated to the file.
They don't have the liability. They don't have the skin in the game. It's a different animal.
So let's go back to where we started, which was clients that are unfortunately defaulting and they're not qualifying. What other things are you seeing that's coming through your door where a client may be denied?
There's different qualifications. So, you see a lot of people that basically just don't have the money. They're first-time home buyers. They're not really understanding the process or really what it takes to have home ownership. So a lot of people think, and they see it on TV, you can get into a house as little as 2% down, 3% down. They don't realize the closing costs are anywhere from 4 to 6%. You're talking about escrows that can be anywhere from $10,000 to $15,000 a year. So if they're collecting 1 year's escrow, 3.5%, and then let's say 2% in closing costs, all of a sudden what they thought was $10,000 to $15,000 getting the house might be $50,000, $60,000, and they just don't have that. So a lot of our denials come from that. Second one we see on a regular basis is self-employed borrowers. Self-employed borrowers where they make great income, and if you look at their business tax returns, the business makes $500,000, $1 million, $2 million, $5 million. You've seen it.
Yeah.
And they report $50,000 a year. So from the standpoint of what their CPA is doing legitimately with the tax laws, they're writing off that income. But from a mortgage standpoint, they don't have the qualifications to get that $500,000 house because they just don't report the income.
Are there still programs for self-employed people?
There are. Years ago, they used to call it stated, no doc, liar loans, whatever you want to call it.
Liar loan.
Because it was. Your income's act, you're saying it's why you're lying. But the reality is now they call it non-QM, non-qualified mortgages. So think about traditional mortgages nowadays where you have pay stubs, W-2s, tax returns. Those are traditional loans. They're called non-QM because they're non-traditional loans. And they do have those for self-employed borrowers. Interest rates are usually about 1 to 2% higher than your traditional rates, which nowadays 6.25 becomes 7.5%, 8%.
Does it still require the same down payment?
No, more. Think about it this way. It's a higher risk because they don't have the income or the traditional income to show. So where we can do 3.5% down, 5% down, they're looking at more like 15, 20, 25% down.
This is going to be a crazy question. Take the person who's self-employed.
Okay.
That has the ability, maybe they didn't file their tax returns. Can they file taxes claiming the income? Does that make sense? Claiming the income, maybe their accountant puts them on payroll.
Yep.
How does something like that work? Or maybe I'm opening up like a bad
No.
Pandora's box here, I don't know.
No, not at all. It's a very good question. So from the
Asking for a friend, just
yeah.
saying.
So timing is everything. When it comes to reporting that income, if they legitimately basically wait till the end of the year and report that, not in the effort of getting the mortgage that they've already wanted the contract for, we can legitimately do that. So let's say somebody reported $50,000 for the last 2 years, but we know they really make more than that, and at the end of this year they report, let's say, $150,000, and 2 or 3 months later they go to buy a house, we can go in a contract, we can use that income. There's a way to do that. What unfortunately we see on a regular basis is kind of what you're alluding to, is that somebody gets in a contract to buy the house, they had their tax returns filed already at $50,000, now they try to get their CPA to amend those returns and say they made $150,000. The underwriters see right through it, the guidelines see right through it, and it just doesn't work.
So you could see from an underwriting standpoint if a tax return has been amended.
Yeah. There's different ways you can report it through the IRS. You can see the different ways that they report and actually see if they've amended the tax returns.
What about down payment money? Are you seeing anybody coming to the table with down payment assistance? Are you seeing any of those programs getting more popular again?
Yeah, look, especially in the last couple of years, the market's through the roof. Especially the Long Island new market, you're seeing bids that are $20,000, $30,000, $50,000 over value. So down payment assistance is definitely a helpful item. Sony May, which is the New York program, is the biggest one I see for down payment assistance in New York. They do up to 2% down payment assistance, 1% down. But again, you do need the closing costs. But home buyers are looking for any advantage, any program they can, and there definitely are some good down payment assistance programs out in the market here and also nationwide.
And I don't know if you know the answer to this, but how are people finding or gaining access to those programs?
It's usually word of mouth. Look, there's an importance of having a good realtor, importance of having a good mortgage person, because they're the ones really driving you to the information. So, look, it is the internet age. You can go to Google and search all this stuff, and I tell my buyers, look into everything. But the reality is your advisors and the people and the staff and the team that you have around you are really going to help guide you to what's available.
Because I get clients that contact me, right? Like you'll send a referral over and
Sure.
somebody will say to me, hey, I'm really interested in purchasing a home, but I think I don't have a large enough down payment. And, I try to keep up on my own resources so that I could be an advocate for the clients as well. But hopefully we'll see more approvals and less denials. So with that in mind, once again, we are speaking with my friend Peter Pescatore, Jet Direct Mortgage. If you are looking to buy, sell, investment property, I'm assuming any type of level of financing pertaining to a mortgage.
Anything residential.
Anything residential. There you go. Consider reaching out to Jet Direct Mortgage. Until next time, stay safe.